Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone, and welcome to another Cambridge Financial Podcast. Over the last several weeks, we have done a number of very successful podcasts. We did How to Create a Tax-Free Retirement Life, and that one received a tremendous amount of accolades, especially with all the stuff that's going on today in our government regarding tax and how to improve on the tax liability for Americans. We also did another podcast on retirement straddles. Will you run out of money before running out of life? And that was also a very, very well received by the audience because it touched upon many issues and concerns that our Americans are facing as they prepare for retirement. We also did the economics of life insurance, which took into consideration many items that most Americans do not pay attention to as they're planning for their retirement life from a business standpoint. We did a fun one, which was things I wished I would have known. And it was very good because I was able to touch upon different items and different questions that I have been getting from my clients over the past 28 years. Obviously, we have hundreds of those, but I think we mentioned 15 or 16 of them that turned out to be very interesting. Another one that we did a couple of weeks ago was features and benefits of life settlement investments, which was one of the major things in the marketplace today. You know, there's a tremendous amount of volatility. Yes, the stock market has been going up quite rapidly, but there's a high probability that over the next 12 to 18 months, the market is going to correct itself. And the same thing will happen with the real estate market. Now, obviously, no one has a crystal ball, but being prepared for something that will happen sooner or later is very, very critical, especially when you are in retirement. So life settlements provide a tremendous opportunity with investments that are not correlated to the stock market or interest rate sensitivity or anything along those lines. And then last week, we did a podcast on how to analyze commercial real estate properties. And that one also received a lot of accolades because I was able to walk the audience through, what it takes to buy a piece of investment property and what are the things that you need to watch for and what are the type of calculations that need to be done in order to make certain that you're doing the right things for yourself, for your family, and for your business. So with that being said, one of the things that I want to cover today, which I think is going to be very critical in the next several months, has to deal with the Trump tax cuts. And what will that do for the tax-free retirement type of planning that we do with our clients on a regular basis? Now, obviously, one of the questions that I get from my clients all the time is, what is the best tax bracket to be in? And my answer is always the same, 0. So if you can go through your retirement life and be able to generate good income that can maintain your standard of living, not only at the time that you retire, but for many, many years down the line, and if you can get that income to be guaranteed for the rest of your life, obviously that's a win-win. But the 0% tax bracket is the best tax bracket that we have today. Now, when you look at the tax, and because of the fact that we do a tremendous amount of tax planning for our clients, when you look at our tax tables today, you will notice that we have 7 different brackets and not including the 0% tax bracket. So in reality, we have 8. The challenge with the tax brackets today is that the lowest bracket would be the 0% tax bracket, but you have to be pretty much an indigent in order to make certain that you don't pay any income taxes today, unless you do a customized tax-preferred retirement program. And that's one of the things that we specialize at Cambridge. Now, the highest tax bracket is 39.6%, which is fairly high, and not including the excise tax for Medicare excise, which is north of 3%. From that perspective. So obviously those are things that are going to be looked at in the new tax planning that the government or the Trump administration is attempting to bring forth. Now, what are the challenges? One of the challenges that the Trump administration is going to have with tax cuts in 2017 and beyond is that more than likely it's going to have to be done under Budget Reconciliation Act. Because otherwise, anything that would be done would be extremely controversial, and it requires primarily a supermajority, which is 3/5 votes in the House and the Senate, and the probability that Donald Trump is going to be able to get a supermajority vote in Congress is pretty much slim to none. Now, budget reconciliation only requires a simple majority, and in this case would be 51. So that means that you could have 50 Republican senators vote in favor of doing some tax cuts, and then the vice president can mark the deciding vote and get it to 51, and then that would pass. The challenge with budget reconciliation is that it's only for 10 years. So that means that, similar to the Bush tax cuts that took place in 2003, any tax reductions that you can push through budget reconciliation will sunset in 10 years, which means that in year 11, taxes would go back to the same level that they are today before any changes to the Trump tax cuts. So that gives us certain fears, but also gives us certain opportunities. Now, remember, what does this mean to you as an American, as a tax-paying American, and for many of you that are either in the process of preparing for retirement because you have maybe 5 to 10 years to go, or maybe you're already entering retirement, you have a year to go, or you may have already been in retirement for a number of years. And the thing is very critical, because the one thing you have to do in order to get to the 0% tax bracket is that you have to be able to pay the tax today on some of the assets that you already have, whether they're non-qualified assets. There are 3 basic tax buckets. You have the taxable bucket. That's where the majority of your investments go to, that I see whenever I engage a client. Then you have the tax-deferred bucket, which also has a tremendous amount of investments, and those includes, and we'll talk about that more in a little bit, your qualified plans and so forth. And then you have the tax-free bucket. Now, in order for you to get to the tax-free bucket, you have to pay the piper today. And that brings about the old Midas commercial, which is, if you don't take care of your car and if you don't change the oil on a regular basis, you either going to pay me now or you're going to pay me later. Well, the same thing happens with taxes. Now, the interesting thing about the approach that budget reconciliation will take is that if all of a sudden taxes go down significantly, especially for middle-class Americans, then that means that moving from the taxable bucket and the tax-deferred bucket to the tax-free bucket is pretty much going to be on sale for the next 10 years. And we may actually be able to tell you the date and the time that the tax sale will sunset 10 years down the line. So the opportunities are tremendous For those of you that are thinking about retiring and that are getting closer to retirement, but by the same token, you're very concerned about lowering your tax liability throughout your retirement years. Now, because of all the work that we do at Cambridge in the area of tax planning and tax-preferred retirement planning, we have created a blueprint for our clients and for many people that just request the information from us. And we have a customized 10-step tax-preferred retirement blueprint. And this is primarily the blueprint that we use with every one of our clients as we engage them in the retirement planning process. And this blueprint, not only do we use it once, we use it every single year with new and existing clients along the way. Now, there are 10 steps in the Cambridge Tax Preferred Retirement Blueprint. And step number one deals with the strategy. And the strategy is, once you go through the blueprint, how am I going to get there? Who's going to help me along those lines? And we can give you a couple of different perspectives when it comes to step one of the strategy. Number one, you need to attend a tax and retirement workshop. And we do those via online webinars, or we can also do them at local colleges and universities. And the reason why we ask each and every one to attend one of those workshops, especially the online workshops, is that it's going to allow you to understand, how this tax planning concept works, and how can you get from a 25, 30, 35 tax bracket and bring it down to a 0% tax bracket at time of retirement. The second thing that we recommend is that you seek assistance from a qualified professional that has a retirement and or tax planning background if necessary. Now, some of you are pretty entrepreneurial, so you may want to run at it and do it yourselves, and you have the ability to do so. Now, it is quite complex and complicated, so if you really don't know how to use financial calculators and you don't understand certain economic principles, it's going to be more challenging, but it can be done from a business perspective. The second thing is, some of you may want to seek out some qualified professionals that you feel may be capable of helping you put into play the 10-step process that we use at Cambridge. And last but not least, you also have the ability to use our firm. And if you use our firm, then obviously you're going to be dealing with a firm and advisors that this is all we do. This is what we specialize in doing. We do it with our eyes closed, and we do it on a regular basis. So we understand all the different parameters because every one of our clients is different. They have different sets of goals and objectives. They have different assets and so forth. And the assets are diversified in many different vehicles that we need to look at from a financial viewpoint. Now, step number two, once you either attend a tax and retirement workshop or you seek the assistance of a qualified professional and or both, is you need to conduct an asset and an audit of all the assets that you have. So, for example, you want to identify all your existing assets and or investment products that you may already own, and you want to write them down by amounts and investment sector types. When it comes to retirement, you cannot have all your eggs in one basket, so you want to make certain that you're totally diversified. But by the same token, you need to understand how much money you have in the different sectors of the economy that you're investing in to make certain that you are diversified and you are well positioned in case the market or interest rate volatility take a downturn for the worse. So that's step number two. Step number three is what we call the taxable bucket. And what we ask our clients to do, if they want to do it themselves, but this is what we do for our clients, is we conduct a future value calculation of all their current non-qualified assets. And that includes future contributions that they may be making to that taxable bucket. Now, what are non-qualified assets? Well, they're primarily your mutual funds, your CDs, your money market funds, stocks, bonds, real estate, business investable assets. And when we ask our clients to conduct a future value calculation, or when we do it for our clients, we want to use a 4% rate of return, we want to use a 6% rate of return, and we want to use an 8% hypothetical rate of return as well, because we want to make certain that depending on where the money is going to be invested, that we do our due diligence in making certain that we can get our clients to a 0% tax bracket if we have a 4, 6, or 8% rate of return over the long term, which are very good rates of returns along those lines. Now, step 4 deals with the tax deferred bucket. Now remember, step 3 is all about the taxable bucket. These are monies that you have already paid taxes on, but the growth of that money is taxable to you every single year. In step 4, which is the tax deferred bucket, it works totally the opposite. The money that you put in your tax deferred bucket has not paid taxes. So the money that you have put in the tax deferred bucket, it is pre-taxed. The money grows also on a pre-tax basis, and upon retirement and distribution, then you not only will pay taxes on the contributions that you already made, but also on the growth of those investments. So what we also ask our clients to do, if they want to do it themselves, is that they also need to do a future value calculation on all their current qualified assets, including the future contributions that they're going to be making. So if you happen to be 50 years of age and you're thinking about retiring at age 65, then you're going to take whatever value you have today in those assets, and then you're going to also figure out the annual contributions that you're going to be making every single year, and then you're going to run a future value calculation using a financial calculator in order to give you the outcomes 15 years from now at age 65, as in my example, based on a 4, 6, and 8% hypothetical rate of return. Now, please remember that the assets inside the tax deferred buckets are primarily your 401ks, your IRAs, your 403b if you happen to be a governmental employee, defined benefit plan, so if you happen to work for a company or the public sector where you may have a pension available to you, that would be part of the tax deferred bucket. If you're self-employed, you would have a SEP, which is a simplified employee pension. You may have a simple IRA, which is another employer-based type plan. You may have a simple 401k. So you have to do not only future value calculations for the taxable bucket in step 3, but also the tax deferred bucket in step 4, because the assets are growing at different rates. And not only that, but they're also growing at different rates, even though you're using the same rate of return, but some are taxable and some are not. So some are going to grow a little faster than the other if you don't have to pay taxes versus having to pay taxes. So even if you run the same values at 6%, but on 6% on one side of the ledger you pay taxes every year, on the other side of the ledger you don't, then the one that doesn't pay taxes on an annual basis is going to grow quicker because of the fact that you don't have that eroding factor of taxation every single year along those lines. Now, step 5 is now where we're going into the tax-free bucket. And what we're doing there is the same thing that we did in step 3 and step 4, the taxable bucket and the tax-deferred bucket. Well, in the tax-free bucket, we're going to do the same thing. We're going to conduct a future value calculation, and then obviously you have the ability to do that yourselves if you know how to do so. And you're going to take a look at all your current tax-free assets, and you're also going to include the future contributions. Now, what's really sad about the tax-free bucket is that the majority of the clients that I have engaged over the past 20 years have very little money, if any, in the tax-free bucket, and it should be the other way around. Now, again, you're going to use the calculations, the same scenario, the 4, 6, and 8% hypothetical rate of return on this bucket. And just so you'll know, the vehicles that are included inside the tax-free bucket are your Roth 401ks, your Roth IRAs, municipal bonds, and personal insurance retirement plans. So we call those PERP. And the reason for that is you want to make certain that once you have all of these calculations done, then you're able to have 3 distinct buckets of investments whereby you will know what the future value would be at a given age that you choose based on the rate of return for those assets. Now, step 6 is where now we start to play our magic and we start to do the type of things that we do so well at Cambridge. Now, again, you also have the ability to do this yourself, or you could seek the assistance of someone else to be able to help you with that. But this is where we start doing internal revenue service calculations. And the idea here is for you and for us to conduct a future value calculation of all currently available internal revenue service deductions, exemptions, and credits that are afforded to Americans in the U.S. today using a 3% annual inflation rate. So for many of us, if we are in our late 30s or early 40s, and we have families, we have children, we have to be able to understand which of those deductions and exemptions and credits are going to carry and for how many years they're going to carry. So for instance, if you are 40 years of age or you're 45 or 50 years of age, by the time you get to age 65, your children are hopefully going to be out of your home. But nevertheless, even if they're not, you're not going to be able to take any exemptions or credits on their behalf because of the fact that they're no longer going to be able to qualify for that. So what are some of the things that we look at? Obviously, we take a look at the standard deductions. So for instance, husband and wife, today the standard deduction is $12,600. So it's $6,300 per spouse. So if you're married, filing jointly is 63 times 2, so that's $12,600. You also have the ability to claim an exemption. An exemption, as we have covered in the past, is primarily a tax break that the IRS gives you just for being alive. In 2016 was $4,050. So you have to add that, and that would be $8,100. So you add the $12,600 to the $8,100, and then obviously you're coming up to that number. Now, what you do is, once you add those two figures, if you happen to be age 50, which is the example that we're using today, you want to grow that money and that amount today at a 3% annual inflation rate, because traditionally speaking, these deductions and exemptions and credits have been increasing by approximately 3%. So you want to run that 3% over the next 15 years in order to give you a given amount. Now, I ran one a couple of weeks ago for one of my clients, and they were actually 50 years of age. So in 15 years from now, that same standard deduction and exemptions that they have today was going to take them to over $32,000 down the line. And that's without taking into consideration that as part of the tax planning for the Trump administration, they want to double the standard deduction. But again, if it's done under Budget Reconciliation Act, then obviously I would just stick to the numbers today. Now, if you're retiring tomorrow and you want to do the calculations over the next 10 years and it gets approved, then yes, use the double standard deduction. Otherwise, just use the basic standard deduction. Again, if you're single, would be $6,300, and if you're filing jointly, would be $12,600. Now, step 7. Now that we have done all the calculations, we did the taxable bucket calculations, we did the tax-deferred bucket calculations, we also did the tax-free bucket calculation, and we proceeded to also do the IRA's calculations in step 6. Now, step 7 is the planning aspect of all these calculations and how you marry them together. So in this scenario, what you're going to want to do, and this is something that we again do for our clients every single day, is you're going to conduct a net present value, what we call an NPV calculation, using again a 3% inflation rate, and you're going to base it on step 3 and 4 in order to determine the adequate investment amounts at retirement that you need to have in each and every one of those buckets in order to offset future taxes via IRS deductions in step 6 that we already took a look at. So for instance, if the step 6 deductions in 15 years from now is $32,000 a year, then what you want to make certain to do is that in step 3 and 4, which is the taxable bucket and the tax-deferred bucket, that you only put sufficient money in those buckets that by the time you and your family get to age 65, that any withdrawal that you're going to make from those buckets would be underneath that $32,000 or at that $32,000 off calculation in order to make certain that you can exempt those strategic deductions from any tax liability in the future. Step 8 is the execution part, because once you're able to do step 1 through 7, then the net present value calculation that you just did in step 7 shall determine the amounts of current assets in step 3, which is the taxable bucket, as I stated earlier, and step 4, this tax deferred bucket, that must be shifted to step 5, which is the tax-free bucket. And you need to do this on an annual basis along with the contributions in order to shelter the majority of retirement assets in the step 5 tax-free bucket vehicle. So what are we trying to accomplish here? Since we know what your tax deductions, your standard deductions, and your exemptions are going to be in the future, and then once you get to age 65, there may be others available, and we're able, depending on the change of laws or tax laws along the way, we're able to mirror and or change these distributions as well. Then you're going to want to start as soon as possible to start moving monies from your taxable and tax deferred bucket to the tax-free bucket. Now, in order for you to do so, you have to pay the taxes on those shifting of assets today. And if all of a sudden the Trump administration is going to reduce that liability, that tax liability today, and at least for the next 10 years, then it's a win-win opportunity for all of us to start shifting some of that money out of a lower tax bracket today, because we have no idea what the future is going to hold. Now, future taxes can either be the same, they can be higher, they can be lower. Now, when you take a look at the unfunded liability that we have in this country for Social Security, Medicare, Medicaid, Medicare Part D, we're looking at $120 trillion in tax liability. When you look at our debt is now sitting at $20 trillion, the probability that after the Budget Reconciliation Act goes through and sunsets, there's a very high probability that the taxes are going to go through the roof, because someone is going to have to pay for that nightmare, and nobody knows how to do so. And the only thing that the government knows how to do, because they don't produce anything, is to keep taking more and more money from each and every one of us in order to meet their retirement guarantees for Americans, and to meet all of the expenses and all the stuff that they spend money on a regular basis. And by the way, this is not a political advertisement, because this not only applies to Republicans, and it also applies to Democrats along those lines. Now, once you've done steps 1 through 8, so you've done all the calculations, you've done all the planning, and you have conducted all the net present value calculations, and you have gone through the execution process of starting to shift assets from step 3 and step 4, which are the taxable and tax deferred bucket, to the tax-free bucket. Then you have to identify, if I'm going to start shifting to step 5, what types of products am I going to use in order to do so. And there you're going to have help. And you're going to have help from people that not only understand tax planning and understand accounting, but they also understand financial products and services that are available in the marketplace. And they're changing all the time, so you have to be careful with that. And the reason for that is that in step 9, which is the product identification step, the creation of economic straddles, and that's financial products combinations that you're going to arrive at, allows for maximum efficiency between the taxable, tax deferred, and tax-free buckets. So the mathematical calculated amounts of assets in Roth IRAs, Roth 401ks, and personal insurance and retirement plans will and or may allow for the following. Now, number one, if we do it the right way, and if you do it the right way, you will pay no taxes on Social Security benefits. Yes, Social Security benefits may be taxable depending on how much other income you have coming into the provisional income calculation. But if we do it the right way, no taxes on Social Security benefits. There will also be no taxes on qualified plan distributions due to provisional income planning offset. And as you know, qualified plan distributions are primarily your step 4, which is your tax deferred bucket, which are all your 401ks and your IRAs. And the reason why you will not have to pay taxes on the distribution, because obviously, everyone tells you that when you retire, if you have a qualified plan, you're going to have to pay taxes. And theoretically, it is correct. But if you do proper planning, you're going to be able to have your cake and eat it too, because you put the money in pre-tax, the money grows tax deferred. And if you do provisional income planning, you'll be able to take the money out on a tax-free basis, because you're going to use the offset of the IRS calculations, the future value calculations on step 6 for all the deductions, exemptions, and credits that you should be receiving in the future. So by the same token, you have no taxes on Social Security benefits, no taxes on qualified plan distributions due to the provisional income planning offset, as I just stated a few seconds ago. No taxes on Roth IRA distributions, because when you put money into a Roth, you have already paid taxes on that money. The money grows tax deferred, and you can pull it out tax free at any given point in time in the future, and no tax liability. There will be no taxes on Roth 401k distributions. Now, obviously, not everyone has the ability to invest in a Roth 401k. If you happen to work for an employer and they don't have a Roth portion in their qualified plans, or they just don't offer a qualified plan, then you have no choice but to do the majority of your investments into a Roth IRA as opposed to a Roth 401k. Now, if you have the opportunity to invest into a Roth 401k, then definitely you're going to be able to take advantage of that, because you can put a lot more money into a Roth 401k because it's an employer-provided qualified plan than you would into a traditional Roth IRA. And last but not least, you will pay no taxes on your personal insurance retirement plan or the PERP distributions along those lines. So again, if you're able to do all these things numerically and mathematically as you should, then obviously no taxes on Social Security, no taxes on qualified plan distributions, no taxes on Roth IRA distributions, no taxes on Roth 401k distributions, and no taxes on PERP distributions, not only in the year that you retire, but also for the rest of your life. Now, obviously, due to this 0% effective tax rate during retirement distribution years, this planning strategy may actually qualify retirees with certain governmental benefits if needed. You can actually be generating $100,000, $200,000 of income because a majority of your investments are in the tax-free bucket, and you're still able to qualify for Medicaid, food stamps, and other government programs. I mean, now you're talking about having a tremendous amount of leverage that very, very few Americans will have in the future unless they do proper planning. Now, the last step is what we call the planning objectives step. And what is beautiful about the first steps, the first 9 steps that we have covered, is that the above depict retirement tax planning distribution system that we have put together for you and that we exercise with each and every one of our clients provides an array of additional benefits for retirees today and in the future. And these benefits, just for information, go as follows. For instance, number one, we're able to provide protection against the risk of dying too soon. Now, when you do tax-preferred insurance planning, you have the ability to protect the survivor spousal income. You're able to provide asset protection against declining interest rates and/or stock market volatility. You're able to protect lost Social Security benefits upon the first death. Remember, if you're married filing jointly and you're taking Social Security distribution, when one of you passes away, the surviving spouse will take the higher Social Security benefit at that point in time moving forward. But when you take the higher one, you lose the one that you had or the one that your spouse had. So there is a liability there that if you do proper planning, you're going to be able to offset that as well. And most important, it also will provide a conduit to guaranteed retirement income along with tax-free income distribution and retirement. It doesn't get any better than this, ladies and gentlemen. Now, the second thing that we do in the type of planning when we engage our clients in these 10 steps is we provide protection against the risk of living too long. Why? Because it provides a foundation for guaranteed retirement income via asset annuitization and/or spend down. So clients that have proper planning done have a lot more leverage and a lot more capability to either annuitize all or a portion of their assets and/or spend down the assets, meaning you're spending principal and interest at the same time. It also creates a guaranteed pension for life. Similar to government pensions and or Social Security benefits. And it also fosters the ability to guarantee fixed and or variable expenses for life as well. So when you're able to protect against the risk of dying too soon or living too long, you're actually doing a tremendous amount of work and benefit for yourself and also for your family. The third area that this type of planning will assist you with is in the protection against the risk of living with a disability. Now, once you do tax-preferred insurance planning, you're able to provide a hedging strategy against long-term care risks in retirement and eradicates lost opportunity cost of premiums and or assets due to a long-term care necessity. And the reason for that is simple. Even if you buy a long-term care policy today and you're age 50, what if you die at age 85 and you die in your sleep? So you were paying premiums for 35 years. You never used a long-term care benefit. So therefore, the premium that you paid plus the opportunity cost, in other words, what you could have done with that premium had you invested that money somewhere else, pretty much goes down the drain over 35 years. If you do the type of planning that we do for our clients, you're going to be able to recapture that by doing proper disability and long-term care planning along those lines. Now, these strategic product straddles provide a tremendous amount of economic leverage when needed most. Last but not least, we also, through this process, provide protection against the risk of living with eroding factors. And obviously, we've talked about the biggest one. So a tax-preferred retirement planning distribution system hedges most retirement risks while providing a conduit for higher income, lower taxes, higher lifestyle, and peace of mind, which is something that every one of my clients wishes that they had more of. Now, all of that system that we've talked to you about is what we call in our firm the Cambridge Capital Management System. And in addition to all the above shown calculations and risk management assessments that we have covered in this podcast, the Cambridge Capital Management System provides the following to our preferred platinum client members. Number one, we do a comprehensive Social Security benefits report. And what this report does for our clients is going to let our clients know exactly when they need to start accessing and triggering Social Security distribution benefits and the timing of those distribution and amounts as well. We also conduct tax forwarding reports to our clients, which gives us the ability and gives our clients the ability to understand future taxes and how to find viable alternatives today that will allow them to minimize and or get rid of all their potential taxes in retirement. Along the way, we also conduct for our clients what is known as a comprehensive economic model. And there we do economic-based models that take into consideration income needs, not only now but in retirement, asset needs now and in retirement, propensity to consume calculations. Things are getting more and more expensive and will continue to get more and more expensive. And what are the assets that they already have that they're more than likely going to have to replace at some point in time in the future? And what is the cost of replacing those assets? Because life happens and things will happen every single day. We also do death and disability calculations. Nobody wants to talk about death. Nobody wants to talk about dying. But as you reach retirement, it is a critical aspect of all the planning that is done. And last but not least, we do economic models on the efficient transfer of assets from yourself to your spouse, to your children, and to the rest of your family along those lines. And how do we make those transfers in the most efficient and effective way of doing so? We also do a comprehensive retirement distribution report. And here's where we start to find vehicles that we feel are very critically important for our clients and how to position themselves from a retirement perspective. First position commercial mortgages, property acquisition programs, life settlements, and guaranteed income vehicles with asset protection features that we make available for our clients that are looking for guarantees and large income distributions in retirement. And then for our preferred platinum members and clients, we offer a monthly webinar educational series in which it is exclusive only to our platinum clients. And we do so because we feel very strongly that the more education our clients have, the better it is for everyone concerned. Last but not least, we do client reviews, and we handle those on a mandatory basis. If we engage a client, we have to be able to like each other because we're going to be speaking to each and every one of our clients a minimum of 3 times per year, especially with our Platinum Client Program, in order to make certain that all the strategic choices that we have made are working properly and will continue to do so for many years to come. Finally, as you all know, and as I tell everyone on each and every one of our podcasts, our number one goal at Cambridge, and my personal number one goal, is to get our clients and friends to change the way they see things. Because when you change the way you see things, the things that you see change. Again, thank you very much for listening to this podcast. Stay tuned to our weekly podcast, and feel free to shoot us an email and let us know what other specific topics, although we find topics every single week to bring to your attention, but please let us know if there's something of interest that you want to see in future podcasts, and we will definitely do that accordingly. So again, have a great day and look forward to seeing you soon next week.